substantial majority of policymakers agreeing it will soon likely be appropriate to slow the pace of hikes. The minutes also seemingly upgrading the possibility of a recession in 2023 as now, quote, likely.
Robert Kiyosaki, world-famous economic and financial strategist and commentator, in his latest broadcast reveals that there's no way we would get a soft landing at the end of the Fed's quantitative tightening. He says what is to come would be worse than a recession. It would be a depression. Are his reasons good enough? What is really going on with the economy? That's what you'll find out in today's video, so watch till the end. But first, click the subscribe button before you go on. Thank you!
What goes up also comes down. And I suspect we might be heading into a depression with inflation. Some people call it stagflation, but this one is so severe because we have a global liquidity crisis. There's no money. It's drying up fast. The biggest problems in the shadow banking system we cannot see, the euro dollar, the euro yen, and all that. So inflation is up, gold prices are down, real estate's crashing. What else could we ask for? Interest rates just go up a little bit, and I was at a big major bank right near my house in Phoenix, and the whole place was empty. Not from customers, but their mortgage department is cleaned out.
Yeah.
And, Twitter just laid off, I don't know how many millions of people. Amazon's laying off people and all that. That's what that means. So we can talk about interest rates and percentages and all this stuff. But the thing is, as we said, what goes up must come down. And the question I'm going to talk to you about is what can a person do? How do you think about this? Because I think we're in a serious, almost a Weimar Republic, what brought Hitler to power type of situation where it's so goofy. And I'm concerned for everybody too, because they're calling for riots in Europe. China's in serious trouble, because when we slow down, they slow down. So this is not just a U.S. thing. This is a global challenge we're coming up to.
Robert mentioned the term stagflation. So what is stagflation? The simultaneous appearance of slow growth, high unemployment, and rising prices is known as the triple threat, what some call a stagflation. A policy solution to slow growth often worsens inflation, and the reverse is also true. This makes fighting stagflation difficult. To bring inflation down, the central bank creates policies to reduce the amount of money in circulation. This is what we call quantitative tightening, QT, which includes increasing interest rates. Again, this causes a problem because QT takes so much money away from the system. There won't even be money for businesses to grow. Then the Fed have to ease on QT and increase money supply yet again, which returns the economy into high inflation. This loop is what Robert Kiyosaki fears would make it difficult to escape with a soft landing. Many are looking forward to an end-of-the-year rally, and the stock market is looking good to deliver this. It is believed, however, that the bullish stock market pattern will collide with fears of stagflation in the near future. Constrained Capital founder Mark Newman said investors would be confused over where to invest in a stagflation scenario. The Dow gained 1.8%, and the S&P 500 gained 1.5%, and the Nasdaq Composite gained 0.7% in a holiday-shortened Thanksgiving week. Fueled by better-than-expected inflation reports, the momentum toward a year-end rush to stocks only seems to be getting stronger. One big market being impacted by rising rates is the real estate sector. Mortgages are up, and house sales are down. By allowing both mortgages and U.S. Treasury securities to run off, the Federal Reserve has also reduced the size of its securities portfolio. Each month, the Fed will allow up to $60 billion of Treasury securities and up to $35 billion of mortgage securities to run off. This has started since September. The last mortgage rates are now 6.87%, according to data from Bankrate. Mortgage rates in the United States rose on Friday, November 25, compared with the previous day, and dropped from last week. So what does the Rich Dad, Poor Dad author think is the best strategy?
We can talk what the Fed's going to do, what the Treasury is going to do, what Wall Street is going to do. A more important question is, what are you going to do? Because you and I are not going to change the Fed. We're not going to change the president. We're not going to change Wall Street, but we can change ourselves. Why do people buy at the height just before it crashes? Why don't they buy when it's low? We all know, if Neiman Marcus had a sale, we'd be shopping. But And they said, well, Neiman Marcus is going to is raising their prices 20%. I said, oh, good, we'll wait till it's high of 20%. And that's what people do with investments. Interest rates were coming down. The debt was going up. So when they raised the interest rate, the debt got more expensive. The question, who pays for that debt, is the taxpayer. And the U.S. dollar right now, I don't know where it is. I mean, but I don't trade foreign exchange, FX, they call it. Yeah. That's a whole nother specialized science. The most important thing, Bert, is over our years of experience, aren't crashes some of the best times to get rich? This one is a big one because it's a long time coming. And the debt has never been higher at any time. I cannot believe it. And they're raising interest rates into it.
While Robert thinks this is a great opportunity for investors, he also thinks the government has set up a system that makes the common person pick up the expensive bill of the debt-run economy. There's a possibility that many Americans will soon find themselves in a situation where they have more debt at higher interest rates while their real wages are declining. Rates are rising on everything from mortgages to car loans to treasuries, which means interest rates are rising on credit card debt as well. Federal funds rate targets have been raised by 0.25% from 4.0% over the last year. Bankrate.com reported earlier this month that the average credit card interest rate has risen to 19.04%. That's a 30-year high and the highest rate since 1991, when it reached 19%. After more than a decade of quantitative easing and really low interest rates, ordinary households may suffer real financial hardship. But this is what we should expect following this year's policy shift at the Federal Reserve that finally allowed interest rates to drift upward.
The Fed's got my back. I buy the dips. I got a 401k. I have a government pension, and those are the things that are going down. And this inflation is now systemic. It's now permanent. And the crime family known as the Bidens, they did that in 2020. What year am I in? 2020, when they got elected, they took off the Keystone XL pipeline. The price of oil went from $30 to $130 a barrel. So I'm selling oil at that time at $30 a barrel because I don't buy oil stocks. I buy the oil in the ground. Went from $30 to $130 a barrel. I almost voted for Biden after this. Thank God. He made me a richer man. But I also realize what they're doing, what these academic, democratic, liberal greenies are doing, is that the poor will always be poor. I mean, this is in the Bible. The poor will always be amongst us. But by raising the price of oil, they took out the middle class. That's intentional.
How are you planning to weather the storm? Let us know in the comments. Remember to subscribe and like this video so we keep bringing you quality content. Thanks for watching.